Hello, good afternoon. You know my name by now, so no point mentioning my name anymore. So today I want us to discuss about hedging, why it is important to hedge your positions, especially when approaching a directional uncertainty. Many of you have heard about hedging this, hedging that, and how to hedge your trades. And most wonders what is hedging. So we will be discussing that today. So to start with, hedging, I say, is an art of opening positions in two different directions in a single game market in order to increase your chances, your winning chances, and by so doing, increasing your profits. Hedging is also an art of protecting an existing position in either direction from unforeseen moves due to uncertainty or high volatility as a result of unexpected events or news. The system we were used to before we had the hedge mode in the market is a one-way mode in which we can only open a trade in one direction and we can't open two positions which are in two different directions. So it's either we go long or we go short. While on the spot market, we can only open a long position. So this is what hedging seems to solve. So in a one-way mode of trading, traders can only open position in one direction only. Any attempt to open a new position in a different direction will result to closure of the initial position. What this means is, in a one-way mode, whereas you can only go long or only go short, if you have a long position and you are approaching a point of resistance and you wish to sell and then probably go short, you have to close your long position first before you can open another position on the short side. So that is how it is on the one-way mode. Or if you are long and you want to sell at resistance, once you place a sell order, it will automatically close your position. If there are excess on the quantity of size you have decided to close, then it will close the initial position and then open a short position in excess of the long position. In a one-way mode of trading, traders can only open a position in one direction only. Any attempt to open a new position in a different direction will result to closure of the initial position. This I explained already. So either a long or buy position or a short or sell position can be opened. So if you already have a long or buy trade active and you desire to go short upon spotting a short setup, you will have to close your long position first and then open a new short or sell position and vice versa. I have also explained this where you have your long and either you wish to go short upon seeing a resistance, maybe you're in profit and price is approaching a resistance, then you will have to sell the long or you close the long position before you can go short. And if you are short in the market and you are pushing a long setup, then you will have to close a short position before you can open any other long position. Initially in crypto trading, traders were able to hedge their position by taking a buy trade on spot, while they short or sell the same asset on the futures market, or rather by using two different accounts to open positions in different directions. What this means is, initially back in late 2016, 2017, where we have the only the one-way method and traders who are trading futures market on the futures market and they wish maybe when the contract are expiring and the price has to converge, both the futures price and the spot price has to converge to be one, they will either take a short sell or a short or sell position on the futures market, whereas on the spot they are longing or buying the assets on the spot market. So you buy on the spot market, whereas you are short on the futures market. So when the prices converge, if the prices on futures are trading below the spot prices, one will go to the other, right? Either the spot prices falls to meet with the futures prices, or the futures prices rises to meet with the spot prices. So you can't be wrong on that. So that was one way traders used to hedge their positions when there was no hedge mode. So this can be done at any time the trader wishes. But most time it is done is when the quarterly futures contracts are expiring, as prices of both the futures and spot markets will converge to end at the same and close as the same rate. Okay, I just explain what I was trying to say here. So either the premium, if we have a premium rate on the futures market, or we have a contango where the spot market is just a bit higher than the futures prices, or where the futures prices is a bit higher or much higher than the spot prices, and the contract is expiring. They cannot expire at different prices. They have to merge. So if the futures price is trading way above the spot prices, and you take a short position on the spot on the futures market, as well, you also long, you buy the same asset, the same contract on the spot market, meaning you are long on spot while short on futures, and you expect the prices to converge. Either the spot prices remain the same while the futures market drops to meet the spot prices, or the futures prices remain the same while the spot market prices goes up to meet the futures prices. They have to merge together. So you can't be wrong. Also, the spot prices, if it's trading below the futures prices, it can as well drop. But if it drops, you will be in profit on the futures trade, whereas you will get stopped out on your spot position. We will explain this in short time. So we have the hedge mode now. So nowadays, crypto exchanges have the hedges to meet the demands of traders, and already have an hedge mode, which allows traders to open trades in both directions at the same time without the use of spots or two different accounts or sub accounts. Like I was saying, using the spot and the futures market accounts, traders also have probably two futures accounts, whereas they go long on one of the futures accounts and they go short on the other futures account. So that is also an edge, but it's old school, as you have to operate two accounts the same time. So nowadays, what the hedge mode does is, in one single account, you can activate the hedge mode, and then you'll be able to open a long position and the short position at the same time, without the short position closing the long position, neither the long position closing the initial short position. So we continue. Assuming that you have a long or buy trade on the 4-hour time frame, and you are in profit of 1 to 3 risk reward ratio, while price is approaching a point of resistance on the daily time frame, knowing fully well that higher time frames take precedence over lower time frames, you may be forced to close your position at the resistance point, as opposed to the saying, letting your winners run, because you can't tell if the resistance will hold or break. So what I'm trying to say here is, assuming you have opened a long position on a 4-hour time frame, you have a good setup, and the setup proceeds to give you a 1 to 3 risk reward win. That means you have 3R in profits, right? But then as you have your 3R, you are pushing a point of resistance on the daily time frame, because it's good to trade the top down approach, where you mark your resistance and support points on the daily before proceeding to the 4-hour. So if you have a support on the 4-hour which you have longed, and then you are in profit already, but you don't want to rush and take profit, you want your winners to run, right? But as you are letting your winners run, you are approaching a daily point of resistance. We all know that reversals do happen from lower time frames, even though higher time frame place higher precedence over lower time frames. So you do not know if you should close your position, your long position, at the daily resistance and look for a new setup, either short or long. So using hedge mode, you will be able to take care of this problem, whereas you won't have to close your long position, but then you will be able to open a new short position. So if the market goes either ways, you will continue to be in profit. So I continue. Hedging is designed to take care of this problem. Instead of closing your entire long position, you can put a protective stop in profit and then open a short position at the resistance point with a stop in place as well. The new position can be of the same size or lesser, but mind you that a lesser position size will present a lesser risk reward against the long position. We will explain this in detail in the next slide. So this is what it means. Assuming you have a long setup on the 4-hour time frame, which here I have marked 4-hour zone. Your risk is $100, assuming you are risking $100. So when you get stopped out here, you are bound to lose $100, which is the same as 1 hour. 1 hour is 1 to 1 risk reward. So you are risking 1 year, and when it goes in profit, you'll be accumulating hours. So you are risking 100 here to stop, and when you are filled and the market does what it does best, at this point you are currently above 1 to 4 risk reward. If you are risking 100 to this zone, that means when you are on 1 to 4 risk reward, it means you are 4 times whatever you are risking here. And this is exactly the point of 1 to 4 risk reward, which means you are up, and price is currently sitting here, right? That means you are in excess. Price is currently sitting here, which means you are in excess. At this point, you have $400. If you are risking $100 here, and this is 4 hours, that's 4 times 400. That means you have 400 at this point. And for price being at this very point, seems like half of the hour. So you are either at 450 at the very moment. This is a 2 hour. If you want to place a protective stop in profit, this is the most technical level where you can place that. Below the technical level, which price came down as in put back to and found support before continuing upwards. So if you want to place your stop, this will be the most technical level where you can place your stop loss. That is why I've written here technical level for protective stop in profit at 2 hours. So at this point, your profit will be 200, right? Also, this is 1 to 3 risk reward. So when price was here, you have $300, right? As you are risking $100. So if you do not want to give much back to the market, you can place your protective stop at the 1 to 3 hour, because when you are here, maybe 3 to 1 is your minimum risk you want to, or the minimum reward you want. So you can lock your profits in at this point and put your protective stop here instead of the 2 hour, which is the most technical level, because price can do something like this. Take your 3 hour out and then proceed to hit the daily resistance. So when price will still be here, it will be advisable to have your stop at the 2 hour, which is the most technical level. And then when price pulls back, if at all it will pull back and then continue, you can put your stop loss at the 3 hour, which then will then lock you $300. But if the price continues to go into the daily resistance, then you can put your stop in profit at the 3 hour. Once you have your stop loss place in profit, either at the 2 hour or at the 4 hour, and here you have $400 in profit, and price is approaching this resistance point, you do not, by the time your trade gets to this point, you probably have 5 hours, right? That is 1 to 5 risk reward, which means $500. And if it is just a bit above 1 to 5 hours, that means you have more than $500 by the time price reaches this resistance point on the daily time frame. So what you may want to do is you may want to open a new short position. You may want to open a new short position at this daily resistance, risking the same amount you have risked here. You want to reach the same amount, and you have your stop loss just above the resistance point. So you are risking from this edge to this edge, you are risking $100 the same way you have done here. So if this resistance fails, as in if you have taken this resistance point, you have shorted the market at this point, whereas you still have your long in place, is still running, right? If this resistance fails and you get stopped out, you will lose 1 hour, which means $100. But you will make an additional 2 hours and even more rewards on your existing long, and as it keeps running. Okay, so what this means is, if this trade were to come or do something like this, maybe run into the zone, fill your short order, then comes down a little, only to take out your stop loss, which is here. That means you will be stopped out at this point, and you'll be stopped out of your short trade, and then you will end up losing $100 here, right? But you have placed your protective stop here, and when price came down from the short, the little retracement, it didn't trigger your stop loss at all. It didn't get there. So, and then price continues to take out this stop loss, which means you have lost $100 here. But then from this 1 to 4 hours, at this point, you probably have your 5 hour, which means at this point you have $500, right? And when the market travels to take out your stop, at this middle of the zone, you probably have 6 hours, which means you are accumulating, you have a profit of $600 on your long profit. And by the time the market take out your stop loss, which is above this zone, you probably have 700 in profit on your long position. So you get taken out of your short position, but your winner on the long position you have taken from the 4 hour is accumulating more profit. This is good in the essence that if you are approaching this daily resistance, you choose to sell this market at this resistance point and close the position permanently. Assuming you have closed the position on this trade, and then you took a new short position, you could have been stopped out of that new short position as well. And then you could have missed out on the excess profit from this zone up, which is in excess of over $200 or $300. Are you getting me? At this point, you have $400, which is 1-to-1 risk reward. So probably at this point, you have 500. At this resistance point, the tip of the proximal of the resistance, or is it the distro of the resistance, you will be having like 550, right? $550 profit, which is 5.5 hours. So if you have closed your position there, you will have taken a profit of only $550 at this point. Then if you decide to go short due to this being a daily resistance with the same risk of $100, you could have been stopped out, which means you could have lost $100 to the short. And at the end of the day, your profits will be $450. Right? But if you refuse to close this your long position, likewise hedging to go short, you could have lost the same amount on the short market, which means you have lost 100. But then your long will accumulate additional profit. If you have 550 at this point, by this point you have 600, and when the stop gets taken out, you have 700. When your short stop gets taken out, you have 700, which means you have an excess of 600 in profits from their long position. Unlike 450, which you will end up with if you have closed a long position permanently and choose to open a new short position. But then there is a catch. Once this stop loss is taken out, there is possibility of the market continue higher. And the more the market continues to rally up, the more profit you'll be making at each hour. So at the end of the day, this might turn to $1,000, and you will end up with a $900 profit minusing the $100 you have lost to the short. I hope you understand the advantage of hedging at this point. Likewise, there is another thing. If you have taken a long position, you have your long position approaching here, and then market runs into it, take your short trade, which means you have a risk of $100, but the short is playing well, the resistance is holding. That means you have protective stop at either 1 to 3, and then the price fills you in there, comes down to take out your long, maybe at a 1 to 3 hour. The moment this stop here gets taken out, that could only mean one thing. It means if this position you are risking now, if this position is your 1 hour, means you are in profit of $400 here. And by this point, you are in profit of $200, which should be your 2 hour on the short position. And here, you are probably in profit of $250. So, what this means is you are taking out of your long profit at 1 to 3, meaning you have a long position closed with $300 profit on the long. But as you have closed this in long on $300 profit, your short has also run into profit of $250. Are you seeing it? You could be thinking that from this point to this point, you have $550. So if you could have sold that on $550, but then for the fact that you salvaged $300 from this position on the long, you are back in profit of that amount you missed out on this entire move on the long position. You missed 250 there as a trace, but then you are making the profit back from the short. So here you are at break even the moment your short position triggers the long stop. And then for this stop to be triggered means the short trade is likely to continue into profit back all the way back down here. And what this means is if this trade continue, assuming this is 1 hour, this is 2 hour, this will be 3 hour, this will be 4 hour, and this will be 5 hour, or maybe this 6 hour. So this trade will earn you a new $600. So if you are to make $600 on this short trade plus the $300 you'll be taking out on here, that's $300 plus $600, and that will give you $900. Are you getting the essence of hedging? So because you are pushing the daily resistance, which you are certain if it will hold or not, instead of closing your position at the resistance point only for price to continue higher, you rather go long, risking an amount. So if this gets stopped out, you make the money back from the long as it continues to go higher. If you are not sure if this will break or it will go down, put a protective stop on your long, and if the short fills you and then decided to walk out, then you'll be stopped in profit on your long, whereas accumulating back the profit on your short. And if it continues to drop, you continue to make more profit. So I have written here, if the daily resistance holds and price falls, your long will be stopped out at 3 hour or 2 hour, depending on where you place the protective stops, which means you will realize $300 or $200 from the long. So if you have your stop here at 2 hour, when price got here, you see your stop here, then it's got taken out. That means you have a profit from the long of $200. But you'll be back in excess of that amount you have missed out on here. You'll make it back on the short the moment this one is taken out. And when price continues, that's additional profit. So you will also be in profit of 2 hour or 3 hour and even more on the short, which means profit of $200 or $300 or even more than that from the short has been taken out at 3 hour of the long, means price has fallen by 2 hour. So if you are taking out 3 hour here, means price has probably fallen 2 hour. And when you are taken out of 2 hour here, price has fallen by 3 hour. So the amount you have missed out on here, you have made it back from the short. And once it continues to go down, that is additional profit. Likewise, if you lose $100 to stop here and the long continues, that amount you have missed here or you have lost here, you have acquired it back. And the moment price continues to go higher, it means additional profit on the long. So that is a beauty of hedging. So there is one more thing. One more way traders may choose to trade with hedge is in a sideways market, or when the trader is unsure of what the market direction may be. The trader can choose to open 2 positions, each in different directions, with the hope that if one is stopped out, the other will run in profit. One disadvantage of this is sometimes the market can be really choppy and then take out both stops on either side before taking to one direction, as we have seen many times with Bitcoin. You may think that the market cannot travel in both directions at the same time. Yes, but then when it goes in the first direction, taking out your stop loss on that side, it might not have offered you a good reward to risk before changing direction to the other side and take out the other stop as well. and you cannot be unsure of when this will happen. Aside of this, it can be of really great potential. So let me quickly explain with a chart what I have been talking about. This is a BNB chart. I will use this as an example, and we are on the daily at this very moment. So BNB is making higher highs. Wow. So this is a daily resistance point. This red line is a daily resistance point. Let me make it thicker if you can see that. Okay. So we have a daily resistance point here, as we have seen a touch here, touch here, touch here, a deviation here, another touch here as resistance, then broke up, and then using it as support. So now let's go into our 4 hour. I have drawn a zone on the 4 hour here, so I will use this to explain what I meant by the hedging. So we have a daily resistance point, right? Then we go into the 4 hours, and then on the 4 hour we have a long position here. We have a long setup here. Market rallied up, came back to test this, and assuming you have filled at this very moment. So what happened is, let me quickly deploy this to make 3R. Okay, so here we are risking an amount, right? That would be our, assuming you are risking $100 here, that would be your 1 hour. So at this next point, that is 1 hour. This is 2 hour. This is 3 hour, which means at this point you have $300 in profit. When the price rallied from here as you got filled to here, you have $100 in profit. Whipsaw, whipsaw, whipsaw. Came here, you have made $200 in profit. Came here, you have made $300 in profit, right? So now look at this. This is 3 hour. This is 2 hour. This is 1 hour. Now look at this. You are approaching a daily resistance point. At this point, this resistance point will be your 4 hour, right? Which means you have $400 in profit. You could have chosen to close this trade. Yeah, you could have chosen to close this trade at this point and make a $400 profit. Then either look for a long setup or short setup. Assuming you have closed this in profit of $400 and you short, here risking $100. Assuming you have risked, let me take this back. Assuming you have shorted here, the moment you close your long, you shorted at this very point. You could see markets has given you probably 2 or 3 hours for this trade. I can't be sure. So, but then it didn't come back here. So you might have your stop in profit below this technical level. This is the most reasonable technical level where you may want to place your stop loss at this point, because or here at that very moment you haven't seen this. So your technical stop may want to be at these very levels here, because this was the lowest high, lowest low before approaching the resistance zone, and price came down. Assuming you have been in a short here, you keep in your long and then you shorted this market. Your short could have been in profit as well of 3R. You could have chosen to take that 3R. You could have chosen to let it wait to probably to get back here. Either trigger this top, then continue the profit downwards. But then what did we see? We saw this market just make a lower high or higher low, and then coming back to trigger this stop on this 4 hour. So whatever stop you have here is taken out. So if you have your stop here, you will be taken out of this short trade, assuming you haven't taken profits here. Because at times, most trades will not give you up to this hour before taking you out. If this is, what is the percentage of this? That is like 2.1. So that is 1 hour, 2 hour, probably 3 hour. Most markets will only give you 1 hour, then take you out. So this is very unique. So your long is not stopped out. So your long, you will be stopped out of your short at this very point, but your long position from here is accumulating more hour up to this extent. Here you have your 4 hour, probably here you have your 5 hour, here 6, here 7, here 8. So if you have reached $100 here you will have been in profit of $800. But if you have closed your long at this point, you will have $400 profit. This worked that way, it gave 3R, so you could have also been in profit of $300 here, which means in total $700. But looking at this trade as it is, if you have also hedged the market, you kept your long, placing your stop here, you shorted the market, is in 3R, you took profit of that 3R, that is $300, and then you let your winner run, as in the long position, you ran up to $800, $800 plus $300, that is $1,100 profit at the end of the day, rather compared to taking a $400 here and $300 on the short, which is $700. You will be in total profit of $1,100. That is how you can use hedge mode or hedging to increase your chances of win. And this even is a good trade because it gave you 3R going by this standard. Because most times the market will not give you that chance at all. The market will do something like this. At the moment it reaches it, give you 1R and then take off like that. So this is a good one. Sometimes it won't happen like that. Sometimes the market will even go straight through it. So you'll be taken out immediately and then you'll be in profit on your long. So that is the first one. Then the second one is you have the same short here, assuming you didn't long at this earlier point, but then you waited for the retracement and then you got long here. So what happened is here you could have closed your trade here. You could have closed your long trade here, which means a $400 profit, and you could have opened a new short, which we saw it worked out. But another thing you can do is you can place a protective stop below the most technical level, which is this point here. Then you go long on this setup, depending on where your stop is. Assuming this is your entire zone, then you want to place your stop just a bit above it. Right? That means you may not have gotten stopped out here. So you have your short position at this point, your long position is still running. Your short got filled, the market started coming down, right? At this point, it didn't take out your profit. Or if the moment price got to this 4R, you have decided to increase your stop limit into 3R. So that is where you have your stop loss on 3R. Then the moment your short is filled there, this you will have been taken out of your long position here, which means you have $300 by this time. You have been taken out on your long. Then the short didn't get back to move up. It only continued back in profit, back to the origin of the move. So if you have reached $100 here and you get stopped out on 3R here, if you didn't even move the stop loss up the moment it got into the resistance and you have left it here, probably you have $200 by this time, $300 here, and you get stopped out on your long on $200. What this means is your $100 at this that you have reached here, by the time market gets to this 2R, you are in profit of 3R already. See, assuming you have your, okay, say 2.6, then this will be 2.6. That will give you like 1 hour there, 5, then 2 hours there, then 3 hours here. So the amount you have missed out on, the $300 or $200 you have missed out on from this point to this point, you have made it back from the market falling from your resistance, which you have shorted, back to this place. And then all the moves from this particular point back to entry is additional 2 or 3 hours. So assuming you get stopped out on 3 hours at this point, you have $300 profit here. Then you have reached $100 here, and at this point, this means this is 2 hours, right? So you have missed out on, because this one is bigger, you have missed out on $100 here. You have been stopped out on 300. Then here you are already making $200. That means you have made back the amount you have missed out on this long. You have made it back on the short. And the continuation to the downside means more profit is accumulating for you. So that is the second example. And the last one, where the market is probably in a sideways position and you choose to rather go long or short. I do not see a sideways action here, but let me use this as an example. When market was probably here, I'm trying to locate a bit of sideways. Okay, let's use this. We have this sideways movement here, which the market seems to be in a range. So what people do is, the moment you see this market is like this, going sideways, they do not know if price will break out or it will break down. So what they do is, at this very moment, they may choose to go long and short. So if at the very price of any price they are in, So they may choose to go long or short at this, assuming price was currently trading at this level. So they may choose to go long here and then short here. If they go long here, then they may want to place their stop loss just below these lows, like this, on the long trade, and then place another stop loss above the trade like this for the short trade. Like I said, this has its own disadvantages as the market can get choppy at times, and that is exactly what we saw here. From this point to this point, if you have your entry here and your stop here, that would be your 1 hour, which is almost excess of 7%, right? And the market, as we could see, it went up and it triggered it went up almost 14%, which is 2 hour, I think, from this. Or it's not up to, okay, it's not up to because of this magnet function. So here is the entry, here is a stop, that is even excess of 12.something%. And then we saw price coming here, which is in excess of 15%. That is 1 hour. So from this long entry, the moment you enter both long and short. You have your stop for short here, you have your stop for long here. Market came up, it triggered your stop on the short side, and it gave you a 1 hour profit, which means if you have both long $100 here as your risk, on both sides, you have reached $100 to the short and $100 to the long. When price came up from this point to this point, you will be taken out of your short. That means you have lost $100, but then you'll be in profit of 1 hour on the long, so you are making back $100. So you are still at break even. You expect the price to continue up to give you more profit, but what did we see the market do? The market came down. After taking out your short stop loss and giving you 1 hour. You wouldn't take that 1 hour profit because it's just break even for you. The moment the market broke up above this range, you believe it will continue going up, so it will give you more profit, but it didn't. It only came back down, and this is where you have your stop loss on the long position. And what did you see the market do? The market triggered your stop loss on the long side. So you were taken out of your short, and you came back to be taken out of your long. It could have been another direction. The market could have chosen to take out your long stop first before going back to take out your short. So the moment your long is taken out and market is going up, you are no longer in a long position, only short, and then your stop loss will be triggered as well. So market got choppy here, took out the stop loss on the short side, came back to take out the stop loss on the long side. And then what did we see market do finally? We saw market rallying up. Whereas you could have been in profit on your long side, assuming the market went up immediately after taking out your short stop without coming back to trigger your long stop. So the market can get choppy, as we have seen here. Whereas sometimes it wouldn't get choppy. It will just break out above, take out your short stop loss, and rally above, giving you more profits on your long trade. And then you wouldn't even realize either you lost anything or not. Likewise, your long position might just be taken out and the market will continue downwards. So this is the other one in which people, when they come to the market and do not know which direction the market may go, they may just choose to trade in both directions. They go long and short at the same time. And as they go long and short, they place their stops. So if market moves in one way and trigger their stop, it will give them profit on the other side. But as we have seen at this particular move, the market was very choppy. So it took out long, it took out short. So that is it about hedging, guys. And I hope you do understand this very much, or the little I have to explain, I hope you understand it. So if you have any question about hedging, do not hesitate to ask. Likewise, do not hesitate to subscribe, share, and like this content, as we are bringing you all this quality education for free. So you should at least support us by liking, subscribing, and sharing. Thank you.